In this episode, we're going to cover, should you sell your home now or should you wait until 2027? Cody and I are going to break it down. All right, welcome back to the Anchored in Real Estate Podcast. That's 2025 Realtor of the Year, Cody Chembars. I'm Johnny Dugan, 2025 Circle of Excellence Award winner. Cody's the managing broker here at Anchor Real Estate Advisors, and we're going to cover a topic today about trying to time up the sale of your property. And what we see, there are thousands of folks, in our market alone, that are still riding the fence and trying to decide, is this year or is it next year or is it 2 years or whatever, but they're just trying to make that decision. And it's a complicated decision sometimes, not one shoe fits all. But we're going to break down the three main factors in trying to decide, is it now or do you wait till 2027? So, number one, Cody, it's what everybody's chasing. It's the interest rates. What's the big thing? So we talked about it. We've got an episode, I think it's episode 3, where we really get into what's called the golden handcuffs. And that's where a lot of people have these ultra low interest rates. And they go, I only give that up. Totally understand it. But if the interest rates are playing a role in your decision to be moving either this year versus next year, how do you approach that? What say you in that regard?
Well, it could go either way, right? So if we've got a seller that is needing to sell their home and maybe they have those golden handcuffs, that low interest rate, or maybe they have a paid off house and they don't necessarily want to enter into that market. They don't have enough equity to purchase a new home for cash. They're looking at it from the perspective of, I don't want a 6% interest rate. And so they really stifle themselves in the ability of what they're going to do. And so we find them in this position, this predicament of, well, I'm waiting for the rates to drop, right? And so what we're seeing now, and we heard this in our Tuesday meeting from our in-house lender, Johns Creek Mortgage, they said that we're seeing government loans sub 6. You remember he said that?
Yeah, absolutely.
Right? Like he locked an FHA loan at 5.75. And so when that word gets out on the street, we're going to have a frenzy again. Yeah. So if you're a seller and you're deciding, well, do I want to sell? You may wait and say, well, if the interest rates go down, we're going to have this high spike in demand. We might see over asking offers. We might see an uptick of an inflated percentage because money is cheaper, right? The idea behind that. But when they go and buy, right? That's the catch-22. Yeah. So what are your thoughts on that? Because we're seeing that now. Yeah. And, I don't know. The buyers they're coming. They're starting to come out of the woodwork.
Yeah. We've talked about before, the mortgage applications are way up. So we know there's demand coming. And it's kind of, regardless of interest rate, the demand is starting to, we've talked about pent up demand is starting to push its way through, regardless of interest rate. However, I've kind of got 2 points on this. One is what you just said. If you're also going to buy, you're going to sell so that you can buy your next home, then it's all relative. It's in regards to timing. There's not a lot of benefit to waiting till next year, in that if you're going to be buying, the market today is favorable for sellers, not as favorable, but still relatively balanced for buyers. Next year, it flips, but it's going to be favorable for one, not as favorable for the other. So you're going to experience both. So waiting for the market in order to make that decision, if you're going to buy, it kind of doesn't matter because it's all relative.
It is relative, yeah.
The other thing is, if you've defined the golden handcuffs, you got this low interest rate, and you kind of just don't want a higher interest rate. But what you're saying, if you're trying to wait till interest rates come down, there's two things. One, you're going to face a whole lot more competition when you go out to buy. And two, also just understand, and it's just a matter of fact, the interest rates aren't coming back down to 3 unless things in the Middle East, escalate globally, and then they have to drop interest rates again, then we're doing a whole lot worse, right? And so the point is we just won't see 3% again. We won't see anything competitive with 3% again. If we saw the mid fives, that would be relatively dramatic. So if you're locked into that interest rate, just understand you're locked into that interest rate forever. You're just never going to move because you're never going to get a competitive interest rate. So I get it. I'm not saying, hey, it's no big deal, just take on a bigger payment. I get it, but I'm saying if you're waiting for the interest to come back down to where you currently are at 3%, that's just never going to happen. So don't let that be what holds you up. At the end of the day, if you can afford it and your family's ready, that's when you make the move, period. Right. And the interest rate is just going to be what it is.
Well, and the other thing too, like as we head into factor 2, but the other thing is like if you're trying to sell your house, right, and waiting for these interest rates, this hypothetical situation, you are entering into a home sale contingent offer, right? Unless you're doing a program like HomeLight where they buy before you sell, right. And that there's pros and cons with that as well. But you're putting yourself in I don't want to say precarious position, but you're putting yourself in a more difficult position because of all that pent-up demand that you mentioned. They're coming in and they don't have a house to sell. They just want to buy a house. Right. Interest rates are low. So then what we saw in 21, 22, these home sale contingencies weren't being accepted because you had offers that were non-contingent.
That's it.
So again, we're not telling them that we're, to hurry up and sell, but we're giving you the wisdom behind it. And so when that timing is right for the family, like you said, and you can afford it, then jump into the market.
Yeah, we covered this a little bit more in a different episode, but I've always been a fan of leaning into and being somewhat aggressive about selling your house first.
Yes.
And you could sell your house, you have it listed, then you can start getting more aggressive about finding the other house. Because if you start by finding the other house, then you're in a very pressure-filled situation to get your house listed quickly, sold. You're going to take more concessions because you're now under the gun to get yours sold so you can buy that other house. So again, there's more nuance to that, but as a rule of thumb, I like to be selling first, get that bird in the bush, if you will, get that money in the bank, and then you can make a really competitive offer when you find the house you love.
Yes, yeah. Absolutely. So factor 2, we're going to talk about is inventory levels.
Yes.
Right? And so, Johnny, what we're seeing right now, inventory is still historically low. We did that whole episode on the Atlanta market, specifically North Georgia market for FMLS data, right? So what are we seeing with inventory and then how many homeowners are waiting to list, in your opinion?
Yeah. So there's a number that we follow. It's called months of inventory. And that is if people stop listing today, how long would it take for the current buyer pool to buy out the current inventory? And that number has gone way up in comparison, but it's still historically relatively low at 4.5 months or so, maybe 4.75. And that number may or may not mean something to you, but an average market, a balanced market, is about 6 months. And we've got about 4.5 months. But the number of homes for sale is even lower historically. So what we expect to see when interest rates shake is kind of this flood to the market. And so it just means more and more competition. When you go to sell your house now, you've got simply less competition. My neighborhood of 100 is going to have 2 homes on the market. So that's 2 out of every 100. So there's not a lot of competition there. And that's good for the seller. It's not awesome for the buyer, but we know that when interest rates shake and people start moving, that there'll be more competition. So that's from a seller perspective. There's plenty of buyers to support the current inventory, and there's less competition right now.
Yeah, and I would agree with that sentiment. We're seeing that in the start of 26. I mean, as we're filming this, it's March 18th. Yeah. But I think, last year, that's where we started to see that month supply starting to tick up.
Yeah.
And that's when we saw the more competition. That's where we saw the corrective market where this $500,000 house that's not worth $500,000 all of a sudden started doing price reductions to try and find the right price. that the market would absorb it, right? And that's what we're attempting to communicate, is that when there is a low month supply, and all these buyers enter the market, that is going to dry up the supply. It's going to be absorbed. And then if we find ourselves in that 21 or late 2020, 21, early 22 market, we were seeing half a month supply or a month supply. And that's what drove the prices up. It was the free money that entered into the market that said, oh, and then the low interest rates, let's gobble up all this inventory. And then the prices skyrocket because supply and demand.
Right.
And then all of a sudden, we had a 25 corrective market. And again, at the end of the day, the supply and demand, it's always going to play a part of it, right? And so that's why we track those stats, the month supply. How quick will it be absorbed by the market? And making sure that we're pricing it strategically versus, like we talked about last episode, was, pray and hope that we get it.
Right. Yeah. Well, stay tuned for the next episode, which we cover the mistakes that sellers are making.
That's right. Yep. That's right. Yep.
So the third factor here is your equity position and understanding your equity position when you're making your decision to sell. So, the one thing that people do is they look on, national side, or they try to get a sense of what their home is worth, and they start doing the math. Tell folks they're kind of the right approach in regards to, I need to understand what I'm going to get so that I can understand what I can go get, and then make sure they've got that right.
Yeah. So what we're seeing, and we've done a couple of campaigns, mailing campaigns, Dahlonega, Dawsonville specifically, where we have reached out to these sellers that are sitting on anywhere between 30 to 60% equity, right? Equity just means money that you've gained without doing anything, just because of the market appreciation, right? So equity, if I bought a house for 100 and in the current market today it's worth 250, you have 150,000 of just equity minus whatever you've paid towards the principal, right? And so what we're suggesting and what we're advocating to these sellers that are sitting on this massive equity is that you could take this equity and you transfer it into another property, right? Like if you need to upgrade, like my family is a family of 7. If we have another baby, we've got to find a housing situation that'll support. It might force us out of a 2.875 interest rate, but we've gained equity through the market appreciation. And so it's not that, yes, I might have a higher payment, but I am taking the money that I did nothing for, right? Just because of the market appreciation. And I'm taking that money and saying, instead of investing it into a short-term rental or whatever, something else, I'm going to take it over here, place it in this upgraded house that will suit our needs, our family needs. And then now I've got that, my payment's going to be lower because I've transferred that profit over there. And, I'm still going to have a higher payment due to the interest rate, but now I've got what I need.
Yeah.
So
now you can make an argument and you go, well, I can do that again next year. I can take my equity over next year. The argument against that is the home you want to buy is going to be that much more expensive next year too. So there's not an argument for or against. Do I wait till 2027 because of my equity? I will have more equity, true, but the house you're buying is probably going to be more expensive. So to me, that's kind of neutral in regards to your decision to wait till next year versus this year. The other part about equity is understanding how much equity you ultimately do have. And what we do as realtors, and this is free, this is when we come in, we'll do a listing appointment or just a consultation with you. And we're going to tell you, this is what I think a range where I think we would list it. And based on that, and all right, let's, you're going to maybe make a concession, you're going to pay some points to the buyer, and you're going to, pay for services. And after all that, you're going to get a bottom line number that says net to seller. And I'm going to say, all right, this is your net to seller. What do you owe? And then we're going to subtract those two numbers. And that's what I call the nut roll that you take from this house to the next one. And that is a number you need to understand when making your decision, because it might not be enough today.
Yes.
It might be, you feel like you need X amount down. Today, you're only going to get $25,000 net to seller, and you'd like that to be $45,000 or whatever. So let's run that number. And then you can say, all right, that's plenty for me to roll into my next home. And then again, it's neutral whether you do it this year or next year, unless you need a bigger chunk of equity before you're comfortable moving on. And then you let the numbers define that.
Yeah. But it's also assuming the market's going to, superlatively inflate like we saw 21, 22.
Yeah.
But then again, if your house inflated, so did the house that you're planning to buy.
Yeah.
Exactly what
the last home I sold, personal home, I sold it and I was just ecstatic at the price. I sold in 2021. There was a line out the door and it just, I was ecstatic about that price. Then I bought another home. Well, if I go back and look at that home that I sold, it's worth like $100,000 more than what I sold it for. And I go, maybe I should have held on to it. Maybe. No, I bought another home and that home appreciated instead. In fact, the home I bought was a little more expensive, so it's appreciated more than that house would have. So that had nothing to do with timing. I sold it in a hot market. I bought my next house in a relatively hot market, but I could say, I timed it just right because I sold at a premium, but I had to buy one, kind of at a premium, but it's still appreciated. So don't let that part be the determining factor where you're like, I think the market's going to crash, or I think it's going to, it doesn't matter. If it crashed, your house will crash. If it crashes next year, that house will. The market's the market. If you're in the market, you're in the market.
Yeah.
Period.
Yeah.
So we want to run a couple scenarios here. And so scenario one, sell now with strong equity versus selling next year with a little more equity. I think we answered that. To me, it's a neutral effect. I don't think it should impact your decision so long as the amount of equity you have now is sufficient to move to what you want. And if you need to build it up more, that's a different scenario. In that case, you stay in, you keep making payments, maybe you make a double payment to build up the equity, that kind of thing. But otherwise, run the numbers, check out your equity, but if you got enough in equity and you're ready, then go. Scenario two, we're waiting for lower interest rates.
Yep.
Waiting is it's like timing any market.
Yep. Yeah. I mean, the reality is everyone's waiting, right?
There's a lot of waiting pattern. If the interest rates come down, the market will loosen up for sure, and it will get a lot more competitive.
Yeah.
And again, that might help you on the sale side, but it's going to hurt you on the buy side. So again, that's another one where when interest rates drop, has a neutral effect for the ease of the buy and sale. Renting the property. Now we hadn't covered that. You've covered this previously because you have a rental property, but renting the property and then buying another one. That's another quick scenario we can run here.
Yeah. Well, and that's where, say you've got that 2.75 or 2.875 and the payment is just, it's very minute compared to, your income, right? It's not this huge debt that's weighing you down on your debt to income. And so you could go in and qualify potentially and say, hey, I have this house. It's $1,500 a month. I'm intending on renting this at $2,200 to $2,500 a month. It's not rented, so they can't really count it as income towards you or not as a debt. But you could potentially qualify to purchase another home, even with that debt on your debt to income ratio, and then you move into this next one, and then we get this the primary that was your former primary, and then put it as a rental.
Yeah.
And now you're starting to build a rental portfolio with free money, right? Mind you, because we're assuming that you've got a sub-3 interest rate, and you're never going to get that, right? Like I'm looking at the scenario that I talked about earlier. If we do have another baby, I mean, we have a big house, but we don't have the bedroom count, right? And so what am I going to do? Am I going to have to liquidate the house that we're in order to pull out the equity and put it down on a $700,000 house that has the bedroom sizes that we need? Or can I qualify for a $500,000 house that fits our needs and then keep this as a rental? And now we've got 2 cash flowing rental properties. Right. So,
if you're watching this and you've been in your house for a while, since say before 2018, 2019, and even if you refinanced, as most people did, there's a really good chance you could afford to keep that house and keep that interest rate and rent it out and then buy another home. You should run that scenario with your agent and the lender. Yeah. yeah. The agent will help you kind of get your numbers together, and then the lender will, of course, be the one that tells you if that is a go, no-go based on your numbers and your income, et cetera. But that's becoming a bigger and bigger, I was going to say issue. It's not an issue, situation that people are executing, and that's another reason why inventory has been held down.
That's
because
right. People
are keeping the houses as rentals or converting them into a rental, and then so they're not putting a house on the market when they go to buy the next house.
That's right.
So that's another reason why inventory is relatively low. All right. Yeah. The bottom line there is, if you're considering selling this year and you're on the fence, consult, find yourself an agent and consult with them. Understand that we're free, generally speaking, until we're really into doing a deal. As far as consults are concerned, and, if you need a cost, or we do CMAs, we'll do a competitive market analysis. We'll give you a good sense of the value of the home. We'll run these scenarios with you, and all that consultation is free. Buy us a cup of coffee. But there's nothing contractual there. It's not like an attorney or an appraiser where you've got to pay them for their services. So just run those scenarios. Find an agent and run those scenarios, and then you can make a decision. Bottom line is, though, when we started this, is do we go now or do we wait till 2027? And the bottom line is, trying to time the market it's a better's fallacy. It's just, you're just hoping that something happens. But if you're selling and then buying, it's all neutral. And if your lender says you've got everything you need, you've got the equity, you've got the income, everything you need, there is virtually no benefit to waiting till next year to buy the home that you want to have.
Yeah, agreed. And at the end of the day, if they're in the North Georgia area, Johnny.
Yes, sir.
They've got to reach out to us, right? They've got to reach out to you and me.
Yeah, be smart about it.
Be smart about it. Run a simple house equity report, and then you're making that informed decision.
Yeah.
And, I would say everything you said was spot on. I would say make sure that, and I don't like this, but at the end of the day, I realize this is part of the market. I was on a listing appointment yesterday, and they said, as most of them do, well, we're interviewing other agents. Interview other agents, right? Because at the end of the day, we all kind of collectively do the same thing, but you want to be comfortable with who you are engaging with in a client relationship. And it's the client, but the important word is a relationship. Yeah. And this is what I told those sellers yesterday, that I'm glad that you're interviewing other people, but at the end of the day, you're going to pick the one that's not going to say that I can get you an astronomical amount for your house. Because I've been on those appointments. Yes. I've lost listing appointments. Yeah. And guess what? They sold at the value that I said it would sell for. Not bragging, but interview and find that person that you're comfortable with, because you are entering into a relationship.
It's a dynamic professional relationship. You have to, and I mean, my approach has always been, it's a professional relationship. We are friendly. We will have a relationship. We will probably be friends, afterwards. We try to make sure of that. But at the same time, you need somebody that you during that interview that you go, I could work with this person. This person is willing to tell me stuff that I might not want to hear, but it's the truth and it's what we need to know. It's just like any other profession. If you've got an attorney, the attorney's going to say, hey, we can't do that. We've got to do it this way. It's what the law says. And we're going to say, hey, the market kind of dictates in this regard. Same as you're an accountant. If you can't speak with your accountant because he's hard-headed, then that's a relationship you don't want to have. So we have no problem. In fact, we generally advocate for interviewing agents, but pick the one that you feel like is going to have that solid professional relationship with you. Yeah.
Agreed.
All right. So as we land the plane here, the idea, doing it 2026 versus 2027, there is good reason to wait. And that is if you've got something financially, you've just started a new job, you started a new business, or you need to build more equity, then it's prudent to wait. But if all the other numbers line up and all you're trying to do is time the market or trying to get the feels right, generally speaking, it's going to be neutral and there's no benefit to waiting until 2027. So bottom line, if you have any questions about it, give us a shout. Anchor Real Estate Advisors. You can find Cody at
Anchorman86 on Facebook and Cody Chembars on Instagram.
That's right. I'm at Mountain Mansions GA on Facebook and the Instagram. You can find us, and I was going to say our phone number, but I keep getting it wrong.
770-744-2575.
Give us a call. We'll set you up, and we'll get you rolling in the right direction.
That's right.
All right.
You are loved.